to be looking at part B of SAICA first board exam. It is called IAC. How are we going to approach looking at the suggested solution is that we're going to start reading the question, then go to the scenario, then move back to the suggested solution. So why are we doing that? We're starting with the question to understand what part of our scenario will be important for us for the purpose of analyzing as well as for the purpose of responding to this question. And let's read together what the question says. The question says, using the forecast information for project drawn provided by Denzel, calculates the IRR and conclude on whether it was the correct decision for TT to go ahead with the drone fleet purchase. Use the WACC rate provided by the director as the benchmark rate. Provide a brief explanation for any relevant amounts. Ignore the information relating to the sale of the planes and ignore VAT. Just to summarize here, we are doing two things. The major part will be to calculate internal rate of return or IRR. And then just one line or two lines, you'll be concluding on whether it is a good decision or it was a good decision for the company to go ahead with the drone fleet purchase. And then WACC will be our benchmark. So that means you're going to be comparing IRR with WACC. If WACC is smaller than IRR, that means it is a good project. It was a correct decision for the company to go ahead. However, if IRR is smaller, that means it was not a correct decision to go ahead, as the projects will not be beneficiary to the company. And then you need to provide a brief explanation for any amounts that is irrelevant. Whether the irrelevant amounts are amounts that could be incurred irrespective of the project. Amounts that are non-monetary, like your depreciation, amortization. So when you come across any details relating to the amounts that could be incurred irrespective of the project or they are non-monetary, you need to bring them. You do not need to bring them out, but you need to talk about them. You have to say depreciation. This is not relevant as it's non-monetary. Probably they're saying we're going to use certain things that are already in the firm. Or if they say they are going to use the employees that are already paid a fixed salary, then in that case, if there's no opportunity cost, that means that is not relevant for the decision making. So you need to write down, do not leave it and not discuss anything about the amounts that you've seen and you've been provided in the scenario, as it is important for you that you discuss the irrelevant amounts. So that is the request that the examiner is making. And then when it's come to the sale of planes, that means we're going to have information relating to the sale of planes. And they are telling us that we need to ignore. Act as if you didn't see that information. You do not have to include information relating to the sale of plane in your calculation of IRR. If you include it, you are wasting your time because it is not relevant for the calculation of IRR in Part B. And the last part of their request is that we ignore VAT, meaning to say anything that has to VAT, whereby you need to exclude VAT or include VAT, you do not have to worry about it. Then, before we move down to assumptions and the suggested solution, we'll go to the scenario. And in the scenario, we're going to look at a section that specifically speaks or talks about the page, the project drawn. So now I'm presenting the scenario to you. If we're looking at the scenario, number 3 specifically talks about agricultural drone fleet proposal. Let us read the summary of what we believe will be important for us. Denzel, which is the director or operational directors, had always been interested on the use of drone in the agricultural space. However, there have always been limitation of batteries as well as the load size. But in the current economy, on the current operation in the agricultural sector, they said those limitations are now fewer Now that means the battery issues and the load size is no longer a problem, right? For that reason, they've said they are deciding to purchase the drones. And they said the reason they want to purchase the drones and because there are a lot of advantages over the planes. And then in these projects, they're going to have to employ the registered pilot or drone pilot. So if you're looking at the advantages, all the advantages that have been listed here are not important for the purpose of the calculation of IRR and concluding on the IRR. For that reason, we're not going to read anything here as it is not important for the purpose of our solution. However, we will move down and look at the section that we believe is important. If we're moving to this part, it tells us how many drones they're going to purchase. They are going to purchase 8 drones, and these drones will operate in the Free States, which is one of their big customers. And they're telling us that these drones will be purchased from the supplier in China, and the name of the supplier is SAICA Advanced Agro Solutions, and then the name that they will keep on using in the scenario is going to be SAICA. They're saying SAICA incur development cost of 40 million for this project, which will be a game changer in the agricultural industry. If we move into those paragraphs, there's nothing important that we need for the purpose of calculating IRR and concluding. Also, this one is not important for the purpose of our conclusion and calculation of IRR. For that reason, this 2 paragraph is not important for the purpose of our calculation of IRR and concluding, and we're not going to read those 2 paragraphs. Then they're telling us the details about the purchase. We know that the details about the purchase will be important for the purpose of the IRR calculation. For that reason, we need to see what they have. They're saying the drones, they will be excluding batteries, meaning to say the batteries will be purchased separately, because we know the drones, in order to work, they will need the batteries. They're saying each drone will cost 220,000 and it will be depreciated over 5 years. However, the wear and tear, which is the SARS allowance, is going to be 5 years, and the period of operation per drone is 5 years, and it will be replaced after the period of 5 years. Now we want to know, when we replace them, what is the replacement value? So they said the resale value after 5 years will be 720,000. And if you're looking at all this information here, it is relevant for the calculation of the purpose of calculating IRR. What is not important here, the depreciation period of 5 years, it means we're going to be depreciating it over this cost over 5 years. The depreciation will not be important because it's non-monetary. However, the purchase cost will be relevant for the purpose of calculating IRR. Then the wear and tear allowance for the purpose of calculating tax, which we will use in our IRR calculation, it will be important. Then we're moving to batteries. If you're looking at batteries, they're telling us each battery works approximately 12 minutes, and then they need approximately 20 minutes to recharge the battery. There are 2 spare batteries to ensure the continuous flying time. That simple conclude that they need 3 batteries per drone. So that means they're going to need 3 times 8 because they have 8 drones. The cost is 40,000. And same, the depreciation is 5 years, and it can be sold for recycling at 70% of the initial cost. The additional thing they will need is the charging station. They said 1 station is required for every drone, meaning to say they will need 8 charging stations. And they said each station costs 50,000. And the benefit that comes with the station is that they're going to get a deduction or additional sales allowance of 125%. If not sold, the replacement and DAS will not be sold. It should not be required. It should not require replacement, and DAS will not be sold. And then the resale value after 5 years, it's 40,000. Then we're moving to operating details. What is in your operating details? It's your details such as your revenue and expense that will be incurred as a result of this project. So what are we told here, if you're looking at this information, is that we're going to need the spray surface. So it's 125 hours per hour, hectares per hour. So in order for the drones to spray the surface, they will need 1 hour will spray 125 hectares. And then operating period, it's 20 hours per day. And then it's 48 weeks per annum. However, in this 48 weeks, there will be downtime of 8 weeks, meaning to say the operationally only gonna be 40 weeks, not 48. Then drone pilots can drive 2 drones. Each pilot can drive 2 drones, and then the shift length is 10 hours, meaning to say now per drone we need 2 drivers per day, because now they can only work 10 hours, but we need 20 hours per day. And then variable cost is 150, and then the salary is 168,000 per hour. The additional information that we require is with regard to the vehicles. They said TT has 4 vehicles which are used for the deployment of crop spraying planes. These were originally intended for disposal, but if the drones are brought into operation, it will be possible to repurpose the vehicles for this operation. So meaning to say this is now relevant. Why is this relevant? Because if it was not used for this project, it would be disposed of and we would get the money. Then they're giving more information about this 4 vehicle. They're saying it was originally bought by 780. It has a current tax value of 390, and then a replacement cost of 825,000. The vehicle can be sold at fair value of 450. The vehicle qualifies for 4-year allowance, and then it has a residual value of 300,000. They're saying if this vehicles are repaired by 12,000, we're gonna get 475,000 each. So meaning to say it is better for the company to repair the vehicle by 12,000 in order to have a replacement cost that is higher than a fair value that is higher than 450. Because if you say 450 minus 475, it gives you additional 25,000, and that 25,000 is higher than repairing it for 12,000. So it is better that we repair this hailstorm damage. They're saying the revenue that we can get per hectare is 170 rand. And then they're saying operating cost and revenue will increase by 6% per annum from the 2nd year. Then if you move down and check if we still have any additional information we need, they've told us we don't need any information regarding the sale of planes in the required, so we're not going to read anything that is sitting here. And then we know that we need to make comparison with IRR with WACC, which is here we have been provided the discount rate, and they said it's 13.5 plus 5%. So that takes us to the end of what we have in this scenario and what was important for us to digest in order to be able to understand how the examiner came about the suggested solution. Now let us look at what we have in the suggested solution. So if we look at the suggested solution, they've provided us the assumptions. All these assumptions are coming straight from the scenario. So what I'm going to do, because this assumption, you do not need to write them like this in the exam. We're not going to go through this assumption because as we go through the suggested solution, you will be addressing the suggested solution using these assumptions. For your purpose and your understanding, you can just read all the information here. However, when it comes to the exam situation or exam room, you do not have to bring down the assumption because you can see there are no marks on those assumptions. Even those 2 marks that are located here are for the information that you are still going to rewrite on the scenario below. So for that reason, this part of the solution, it is not that required for your purpose and understanding of the suggested solution. Now let's move down to the suggested solution and see what we have been provided in the suggested solution. In the suggested solution, we have been given a period of 5 years. The reason we are given 5 years is because we know the project is over 5 years. Thereafter, everything that we have in the project will be replaced. So let us calculate then for 5 years. We're going to have year 0, which is the first year where we consider the purchase of everything that we need, and then 5th year, it's basically the last year where we resell everything. Okay, then they said development cost of drones. We were told about the development costs that are going to be incurred by the developer. So that cost is irrelevant for our decision making. That 40 million, it's irrelevant. And then we need to say that the development cost of drones, it's not the cost to TT. Therefore, it's irrelevant. So we do not have to consider the 40 million that will be incurred by ZAGG. And then if we move down, there's a depreciation. As I've already said when we're going through the scenario, the depreciation will be relevant for decision making as it is not a cash cost. And then we're going to move to the maintenance and variable cost. The maintenance and variable cost, we see this amount. I want you to understand how did we arrive at this 20 times 5 times 40 times 125 times 8 and 150. So I have written here 20 is 20 hours per day, 5 days per week because we don't work on weekend, and 40 weeks, which is 48 minus the 8, which is going to be the idle weeks because of bad weather condition. And then 125, it's 125 hectares per hour. And then the variable cost per hectare, we have been told that is 150 rand. So now you understand how did we arrive at all those variables that we have here. And then the 8 is obviously 8 number of drone pilot. Then we move to salary. If we're looking at the salary, we have 8 times 168. We know that it's 168 per driver, and we're going to need a total of 8 drivers, as the drivers only work 10 hours, but we need 10 hours per day because we have a valuable 20 hours per day that we need. Then what happens then from year 2, we're going to increase all the cost by 6%. Where is this information coming from? It is coming straight from the scenario. They said all the costs are estimated to increase by 6%. Then once we're done with that, we're going to move to revenue. Revenue for per drone, we've been told it's 170 per hectare. And then we know we have 8 drivers. And then it's 125 spray time per hour, hectare per hour. Then it's 40, which is what I've already discussed. It's 40 minus 8. Then 5, it's 5 days a week. And then 20 is related to 20 hours working hours per day. So what I've said here, I said the variables used are the same as the variable used in the variable cost calculation. The only difference is that we are now using the revenue per hectare. So all the variables are the same. The only thing that differs is that here they use variable cost per hectare, and here we're using variable revenue per hectare. It is the same thing. As we move along, we're going to have to start increasing from year 2 by 6%. So we're going to use the information that we've been provided as the assumptions. Then we multiply by, we add 6% every year until year 5. Then what do we get here? We're getting operational profit, which is basically your revenue minus operating cost. So what else do we know that we need to take into account? And now we need to take into account the other costs, like your purchase of drones. It's 8 times 220. That information we provide in this scenario. Just by adding the information that you have from the scenario, you're getting a 4 mark. Then the purchase of batteries, we are told that they need 3 batteries per Tron, and then we have 8 Trons. Then we multiply by the cost price, which we provided. Then that gives us 960. And then we're told that we're going to need the charging station. The charging station, we need 1 charging station per Tron, which means you need 8 charging station, and we're told it will cost us 50,000 per charging station. Then the next part, it will regard to how much we're gonna get when we were to sell the Trons in future. We'll get 72,000 times 8, and that is an inflow at the end of year 5. The sale of batteries, they said we're gonna get 70% of the original price of 40,000, and then it's total of 3 batteries per 8 for 8 Trons. And then what we're gonna get is an inflow of 672,000. Then the market value of station 40 times 8, and then there's an inflow of 330,000. Then we have the opportunity cost. What is this opportunity coming from? Instead of selling and getting proceed on the sales of 4 vehicles we are going to use for this project, and we're going to use the highest amount, because for relevant decision making you use the best possible amount available. In this case, it's 475,000 times 4, which means this is an opportunity cost, or it's a cost we could have received if you were to repair the vehicle from hailstorm damage and sell it to the market. The next one is going to be a cost of repair, which is 12,000 per vehicle, and it's a sort of 4 vehicle, which gives us 48,000. Why are we putting this? Because for the market value, we use the highest possible, which is only going to be attained if we go ahead and repair this vehicle. The sale of the vehicle at the end of the project is going to be an inflow. We have been provided the amount of 300,000 times 4, which gives us an inflow of 1.2 million. Then the planes crop sprayer implication, it's not relevant because it's not incremental. It was going to be incurred regardless. And then now we have cash flow. So if you look at the cash flow, we have all the cash flows, cash outflow, and all the cash inflows. And then if you take into account the cash outflows and the cash inflows, then you're gonna get WhatsApp audio. Then you're gonna get the IRR of 1156. And if you're looking at this 1156, it basically shows that it's greater than what we have been provided for, work in this scenario. However, we're not done with what we're doing here. We still need to get the taxation amount, because this amount here of cash flow came about after we have taken out all the tax. Now, how we went about calculating tax, we said, what was the operating cash flows, which we've calculated by saying revenue minus all the expenses, and then the went here, we provided that it's 4 years, and then the charging of station, we are told that you're gonna get an additional allowance. And how do we get it? It is 3 times 8 times 40 plus 1 times 8 times 50, then multiply by 125%, which is the allowance that we have been provided, and it's gonna be 1.7 million in year 1. And then they're going to be recoupment of Trons, which you know of already from the above, and the recoupment of batteries, the recoupment of solar station, all this amount you already have from the top. So you see, this amount, you receive them twice. You receive them here in the top calculation, plus you're going to receive the full amount for the calculation of tax. All this amount are same as what we have on top. If you can just look again, it's same. And you're going to get 2 marks per calculation of this recoupment. It's just that it's located in different areas. And then you have avoided recoupment vehicles. So it's 475 minus 390 times 4 vehicles, which gives us 340. Then the cost of repair vehicles, it's 48,000, which is that 12 times 4, which we have. And then we have wear and tear on vehicle now reduced. It's 390 over 12. Over 2 times 4. And then recoupment at the end of the vehicle, it's 1.2 million. Then when you're calculating everything now using SARS allowances, you are going to get the net amount of tax for at 27% of this amount. So that is basically what you get is net multiplied by 27%. So what is your new taxable income? This is your taxable income, then you multiply by 27%. So then what does it mean you were going to need here? First thing, I would have suggested that you start with the calculation of taxation. Why? Because you need the taxation for the calculation of your net present value. So for that reason, once you calculate taxation, you'll be able to have input for the inclusion of your taxation. So you start with your taxation, then you have inclusion amount that you're going to use for the purpose of calculating your cash flows. Then once you have cash flows, that is only when you're going to be able to calculate IRR. If you don't know how to calculate IRR, there is a paper where I took you through how you're going to calculate IRR, and it is one of my previous video. Please check one of paper 1 or paper 2. That way you're going to see how to calculate IRR. Thank you so much for listening up until this far. All the best for your upcoming exam, and bye-bye.